23rd investment webinar presented by Portfolio Builder. Folks, want to welcome you in. Thank you for your time to join us here today, and look forward to showing you how we are set up to basically have a bulletproof portfolio coming into the election here, and explaining everything that's going on in the market today, all the things that we're watching. All right, so welcome in, and thank you very much for your time. Now, folks, if you're on a free trial and you haven't saved my number yet, please feel free to save it. It's in the bottom right-hand corner of your screen. That number is 505-322-7515. And folks, a quick look at the portfolio here. Have a little bit of drawdown today because the S&P 500 is down, and we have our majority position in the S&P 500, but that's okay. And looking for a nice ride up here eventually once we get some stimulus in place. And with that, folks, I'm going to go ahead and turn it over to Jason to start the official presentation here. Thank you so much for joining us here, folks. And real quick, if you haven't yet and you're on a trial, add support@portfoliobuilder.io to your email provider, and make sure to save my number of 505-322-7515 so you can reach out to me at any point in time with any questions you do have. Thank you so much, folks. With that, Jason, I'll turn it over to you, bud.
Okay, wonderful. Thank you so much. All right, guys, so let's talk about the portfolio, how we're positioned, what's happening in politics. Government spending is really key to get out of this lockdown mess. And so the good news overnight is that the House passed a spending bill, a stopgap to keep the government funded till December 11th. So now it will be up to the Senate to pass that today. So we'll see if that goes through. The last bill was declined, and I guess it was because they were cutting out funds for farmers. So with that said, let's take a look at the portfolio, how we're positioned, what our predictions are, and how you need to play the markets. And so the bottom line is the US government is really stuck in a trap, and I can't stop showing you this single chart here. So this is what you do when you have a crisis. Rather than bear the pain, the political situation is that voters would prefer to delay the pain as much as possible and try to essentially devalue the dollar to try to offset losses in the economy. And so we use the government to do this when banks aren't willing to do that. And so think about the housing bubble crashing in 2008. And what we're looking at here is how the US government dealt with that crisis. Rather than letting the big banks go under, what happened? They got basically a little reward for crashing the entire US housing. So they got bailed out. The bankers got bailed out. They did not get in any trouble whatsoever. And it's really sad to say that. But there you go. So the biggest bailout to bankers historically was right there. And you can see it in the dollar going from about $1 trillion in the Fed's balance sheet to a quick jump to 2 trillion. But you can see we didn't really get out of the mess until we had grown the balance sheet to $4 trillion. So that's pretty wild, right? We went from $1 trillion Fed balance sheet up to 4 trillion. And that was over the course of 5 years. Now, what happened? Stock market more than doubled during that period. Now, ask yourself, did companies really become that much more profitable? Did they double their profits and earnings? Or did the purchasing power of the dollar essentially drop in half? So if we look at the prices of houses, we look at the prices of stocks during this period of time, they all essentially more than doubled during a period of quantitative easing. And what I want to argue to you today is that perhaps not necessarily the value of houses or stocks rising so rapidly. It's actually the purchasing power of the dollar is declining rapidly. And so when we look at this jump that we've just put into the Fed's balance sheet, we went from 4 trillion to 7 trillion. Okay, so we had the growth of the Fed's balance sheet that took almost 5 years in 2 months. Okay, so let that sink in. 5 years of devaluing the dollar to make the last recovery under the Obama administration, bailing out the bankers who should have been allowed to go bankrupt. Well, we're repeating that same strategy today, except at a extremely faster pace. So we just devalued the dollar from sitting at a $4 trillion level to 7 trillion. And my expectation is within the next 10 years, that 7 trillion will be 14 trillion. And that's just really a conservative view of what's going to happen. When we look at all the liabilities of the American, it's just insane. There's no way out of this mess except to print, print, print. So when we look at going into retirement, we really need to prepare for your purchasing power to decline probably at a rate of about 10% a year. So if you're just sitting in cash, you should expect to have 10% less purchasing power per year at a minimum because of what the US government's doing. It's spending money it doesn't have. Now, many people don't realize this, but when you go about spending money you don't have, the only way to make that work is to print more dollars. So if you think about it, if there's a limited supply of goods and services, and we're increasing the quantity of dollars fighting over those goods and services, what's going to happen to prices? Well, they're going to rise. Okay, and so that's obviously what's happened for the last century, as the U.S. government rarely has ever had a positive government spend against its tax receipts. And so we're going down this hole where it's the freeloading of America. It's getting worse by the day. And unfortunately, they control the political environment with the vote. So the freeloading is not going to stop. The money printing is only going to speed up. And we need to look at where we need to park our cash to be protected. Now think about it. Where do the super rich park their money? Of course, it's in stocks. Now, why would they want to be in stocks? Stocks have a huge advantage. Not only do they control the goods and services whose prices are going to rise and be fought over by this new supply of dollars, the corporations at the same time are taking advantage of 0% federal funds rate by borrowing almost $1 trillion this year so far. And most of that money in the corporate bond market is not going to CAPEX. So they're not hiring people and really trying to innovate. Oh, no. What they're interested in doing is buying out the competition so they can monopolize their market. And they're interested in buying back their own shares, which means there's less shares outstanding, controlling the goods and services that are sold to the American people. So we have on one side a never-ending supply of debt, which creates a never-ending growth of US dollars, diluting the value of every dollar. And then at the same time, we have the companies who control all of the goods and services, reducing their outstanding shares. So it's no wonder why stocks go up almost all of the time. And when we're in a period of quantitative easing, you really have to be worried about inflationary problems causing your purchasing power to crash. And when we get through this presentation, we'll look at your options to really guard your wealth. And there's really basically four main markets we're really interested in. And we could even nail it down to three. We have the stock market, the treasury market, the bond market of the government, and then we have commodities. And so where do we want to park our capital to avoid losing purchasing power for the rest of your retirement? Okay, so that's the big picture. Now in the short term, we're dealing with some speed bumps along the way. And the speed bumps we have coming at us are basically a fight over how to spend the deficit. So we look like we're going to pass a basic spending bill to keep the government funded to December 11th, and that should come today. So that is a major level of support for the stock market to stabilize this recent sell-off. And this recent sell-off, I would argue, was completely caused by Tesla, which we're going to look at. This is one of the biggest bubbles in the last decade, and it is critical to track that Tesla stock to see what the risk sentiment is into the future. We're going to look at that. But the bottom line is right now, the long-term picture is for the stock market to most likely double in the next decade. and for the central bank's balance sheet to double. Okay, so that's our big picture and how long we'll most likely be holding on to UPRO. There's a few things that would make me want to exit UPRO, but this is the long-term core position of our portfolio, and it will rarely change. Now, we could potentially alter the stocks we prefer based on the election results. I'll cover that in a minute. But this is our core position. And I do expect in the next 3 years, no less than a 200% return on UPRO. Okay, and that's really how long I think we're going to have the stock market on steroids because of aggressive quantitative easing as we try to essentially fight deflation caused by global lockdowns. Okay, but we got to realize there are bumps in the road. And to smooth out the bumps, we have a massive downside protection in the UVXY product. This is the Ultra VIX short-term futures ETF. These two assets have a completely different timeline. And so while we're essentially invested in UPRO for a lifetime with very few obstacles ahead, and we'll talk about what those obstacles could be. But again, we're a long ways away from really what ends the party, and that's runaway inflation that causes the Fed to hike interest rates. But in the short term, we got to worry about election results. We got to worry about the lack of stimulus because of the election, which has really been driving this recovery. And we got to worry about more lockdowns into next year. Unfortunately, Europe is now going into lockdowns. The UK is going into relatively strict lockdowns. Australia is getting absolutely crazy with lockdowns. Ireland just made it illegal to go visit your own family members. Okay, and this is when the hospitalizations and fatalities are falling off a cliff. They're doing this all based on cases. Imagine if we locked down the country over the last 100 years every time there was a spike of people with the common cold. Okay, so it's absolutely ludicrous, but that is another potential speed bump in our way. So the portfolio is essentially 60% long equities, predicting that there will be stimulus, although that stimulus can be delayed because of the election. We realize that is a core risk going into October, November. We have 32% of our assets long the volatility product. And what I'll show you is during the March crash, UVXY returned 1,400%. Okay, so if you have about $300 long UVXY out of a $1,000 portfolio, and it goes up 1,000%, you've turned your $1,000 investment into $3,000. So we actually would look forward to an absolute stock market crash at any point in time because we always have our downside insurance. And because the market has become so complacent and have relied on the Fed put for so long, buying insurance right now is cheap. In fact, when we look at the next few futures contracts for the VIX, you'll see that they're priced about $5 higher than the front month, making UVXY extremely attractive going into October, November, December. Okay, so this is our core positions. And again, they're working on different time horizons. UVXY is really your life insurance. When there's extreme volatility that was unpredictable, that's going to pay off massively for you. But in the long run, we know what the government has to do. They have to keep printing money. That's the only way to win the vote, is to hand out freebies, which controls the American government. And to do so, we're going to have to keep printing money. It's a big illusion to buy votes. And at the end of the day, that's what's creating the inflation in financial assets. So we're in a period of most likely the fastest growth of quantitative easing America has ever seen, which means you really have to be playing the stock market. Now, the other positions I like that are currently not on our plate are two other positions. One is to go long silver. We got investors out of silver and sidestepped a huge sell-off. Okay, so that was a good move out of the way. And keep in mind, we've actually delivered probably about a little less than half of our total profits have been playing gold for the last 3 years. I like to play gold, predicting quantitative easing is coming. But now that we're in the midst of quantitative easing, silver is much more attractive. So we're waiting for stimulus to be passed, and I'm estimating it'll be over $1.5 trillion stimulus deal passed once it does come, to re-engage with precious metals and to also short the US Treasury market. We're going to look at why the US Treasury market went from one of the best investments over the last 4 decades to probably the worst investment for the next several decades. And so we can play the bond market crash with a very easy to use ETF, the Triple T. So basically, this is our positioning heading into October, November, December. It's extremely safe from large amounts of volatility and positions you for massive gains to protect your wealth and your purchasing power into the future. Now, the second we get stimulus passed, expect us to dramatically reduce our volatility play, if not drop it to zero, and go long silver and short US Treasuries. That'll be the only adjustment I see us making in the near term. Okay, so that's the outline. Now, the final play is Moderna. This is an inside job. They're making some breakthrough technologies. As much as I don't like rushing out vaccines, I do think this vaccine will work on the current pandemic, and that they are really positioned to make a significant amount of money for the next several decades. Now, from our point of view, we know that Moderna is in phase 3. We played phase 1 and phase 2 and made some very nice profits from that. We're heading into phase 3 results, and that result will most likely be beginning to release in October ahead of the election, and they'll probably be rolling out this vaccine in November, December. Okay, so that's really the hot stock that really is attractive when we see that Trump is promoting it, Bill Gates is promoting it, and the NIH has a partnership or a patent claim on Moderna's vaccine. So it's really quite an inside job. Now we're looking to potentially sell this above 100 coming into the phase 3. And then as people take profits, very well likely we can get right back into that position. So it's a whole lot to understand what Moderna is doing. But the bottom line is this particular virus that is spreading the world is not mutating. Okay, and when we look at which vaccines are actually efficient, it's those that are fighting stable viruses that don't mutate. And so that's exactly what we have with the coronavirus. So I'm actually expecting the Moderna to be highly efficient at protecting elderly from the coronavirus. So I love this play headed into phase 3. If we look at the summary of assets, we have 60% of our portfolio long UPRO, which is the S&P 500, predicting that the government is trapped. They must do massive stimulus, and the Fed must do quantitative easing to support that stimulus. The catch is we're in a heated election, and there's a good chance that stimulus could be blocked. Now, the good news is we have passed the normal government budget, which is already basically a massive amount of stimulus to the US economy as it stands. And we have that potentially passing in the Senate today to fund the government through December 11th. The next big bill is most likely $1 to $2 trillion. And again, it's more freebies to try to stimulate the economy while we remain in lockdowns across the country. The next big stimulus we can predict in 2021, regardless of who wins the election, will be a multi-trillion-dollar infrastructure deal. So the bottom line is the Fed's balance sheet is going to grow at the fastest pace in history. It's going to destroy the purchasing power of the dollar, and you really have no choice. When we look at the options, we're going to boil it down to either you want to be buying commodities or stocks. And in the commodity basket, we're going to be deciding whether it should be in gold and silver or should it be in oil and copper. Okay, and a lot of that may have to do with who wins the election. On the stock side, we're going to be making a decision. Do we believe we're going to reopen the US economy, save the hotel industry, save the restaurant industry? If so, the S&P 500 is by far the better bet. Those sectors are beaten down and selling at very low prices. if we're going to predict that there's a new lockdown for most of 2021, well, then those industries are going to get murdered. And we'd rather be playing the technology stocks that have a huge advantage. So those are the main decisions we have until this period of quantitative easing comes to an end. And really, the only thing that will stop the government from spending and stop the Federal Reserve from printing will be too much inflation, forcing the Fed to hike interest rates. And that is at least 3 years away. Now, I do want to take a quick break to do a poll. We want to get a feel for what size of a portfolio our clients are managing. Because if you are over $100,000 portfolio, we can actually make this strategy even safer for you. So in our evening webinar coming up at 3 p.m., we're going to take this very similar asset allocation. We're going to pull 10% out of the UVXY position, and we're going to buy an in the money or a near the money put option that absolutely locks you in so that you cannot experience more volatility through the election with a SPY put option. So we have a 8% SPY put option instead of having so much on UVXY for our option trading evening webinar. So it's the same underlying assets, but we're going to actually make it a little less risky and put in the put option plays. So let's go ahead and run that poll, Dean, and see what questions people have here. And when we look at the track record, what I want to point out is that we had a 25% return in 2019. In 2018, December was a 15% crash. We only had a 2.5% drawdown. In 2020, when stocks fell 34%, we hardly budged, 9% drawdown. And typically after periods of drawdown, we have the best returns ahead. So we're having a little bit of drawdown in September after coming off very, very attractive returns in July and August. And I'm expecting to have really extremely high returns for the next 3 years because of this phenomenon. Okay, it does look like we have some poll answers coming in. Now, how do they find their poll if they're not quite sure on that?
Hey team, so real quick, if you are on a trial, guys, and you're not one of our clients yet, make sure to go ahead and respond to the poll. To do that, folks, simply scroll down to the very bottom of your screen. Okay, when you scroll down to the very bottom of your screen in the Zoom platform here, what's going to happen, folks, is a gray bar is going to pop up. It's the little toolbar for Zoom, and then you're going to see something that says polls. Okay, and it's going to have 3 vertical bars. Go ahead and click on that and respond to the question in there, okay? Because it's going to be really, really imperative to the later part of our conversation, just really walking you through some examples step by step of how bad the inflation cash fire is today and how that's going to affect your ecosystem. So once again, just scroll down to the very bottom of the screen. Okay, in the Zoom platform here, or the webinar platform, if you haven't used Zoom before. And when you see that polls icon, for me, it's kind of right in the middle of my screen. Just click on that and respond to question number 1 and question number 2, so you can have a really good idea as to what that's doing to your investment ecosystem today. All right, and folks, want to thank you for taking the time to do that there. And with that, Jason, go ahead and hand it back to you, bud.
Okay, great. So I do see a few questions. Let's see. YS Tong says, should I sell? No, if we're going to sell UPRO, I'll tell you to sell it. Our strategy is, again, to remain long stocks and hedge against volatility. So that's really the key here. Now, yeah, if I really think we need to sell UPRO for a very temporary period of time, I will alert that. So yeah, okay, Tracy says, if I don't have the full 1,000 to complete, should I buy a little extra UPRO? Yeah, just keep the ratio. So it's a 10 to 12 ratio of UPRO to UVXY. So, if you wanted to make it easy, 1-for-1 is a more simplified version of that. And we do have poll answers coming in. And again, for those of you who do have over $100,000, That product's actually trying to make a smaller return per year, but with less volatility and far less risk. So we found that the larger account sizes, especially when we get in the $1 million plus accounts, you would much rather have zero risk and make a very safe, steady return compared to our clients under the $100,000 who realize, hey, we want to make a very nice, handsome return because we haven't saved enough for retirement. So we need to take a little more risk. So the buy and hold portfolio that you're seeing today does not trade options, and it does have to really look at the long game. Okay, so the long game is stocks are going to go up. The long game is that the Fed is going to print trillions of dollars. The long game is that the government is going to be forced to stimulate the economy. So the long game is you want to hold UPRO for a very long period of time. The short game is predicting when volatility is a risk. So heading into the election is a high risk. Does it mean we're going to crash? No. Does it mean there's a risk? Yes. So that's why we want to have this extra large UVXY position just in case. The second we get stimulus through, we're going to dramatically reduce our hedge and go long silver and short treasuries. So that's what you can expect heading into the election. Now, when's the stimulus coming through? We will see. We will have to see. De Blasio just had to furlough 8,000 workers. Okay, so Nancy Pelosi is under tremendous pressure from her own base, from her own governors and mayors. They're desperate for bailout money. Okay, so they really need to move, and the stimulus could come sooner than expected. The second that stimulus comes through, I guarantee you, you're going to see the stock market start having massive moves to the upside. And it very well could do that right now, even before the stimulus comes, because the market's not stupid. They know the government is trapped. They know that stimulus must come. So this is the positioning heading into the election.
Yep. And Jason, do you want to walk Wyatt's tongue through the disaster scenario, like what happened in Q1 and what that would do to the portfolio currently? I think that's really important for people to understand how much money that they'll make with the current setup if the market does crash. Okay. And what that example would look like. I think that's really kind of smart to walk through.
Okay, there you go. So UVXY, if you had bought in February, you made a over 1,100% return. So if you had 10% of your account in UVXY and held to the bottom of the crash, basically waited for stimulus and the Fed to step in, you essentially doubled your net worth. Now we have you at 30%. So you would triple your net worth if we have an event like March. Okay, so you are protected against any serious volatility. And when we look at the long game, we don't mind moderate volatility. Okay, we don't mind moderate volatility to hold stocks, expecting the government has no option but to do bailouts. Basically, this is bailout nation right now. So we can predict that is going to happen, and we can tolerate modest volatility. It's really extreme volatility that is uncomfortable, and that's what UVXY, without a question, does for your portfolio. And right now we have you 30% long volatility. Now here's what's interesting. We may actually see this UVXY product travel higher even if stocks are traveling higher. Imagine that your hedge makes money for you into the election as stocks potentially make money at the same time. So this is how UVXY is designed. It's trading the front month and the next month in the futures contracts. And so we can see this month's contracts priced at 25.40, while the October contract is priced at 30.40. So our expectation is this gap will close as we head into October and essentially drive the price of UVXY almost regardless of what's happening in the underlying stock market. Okay, so it's a beautiful opportunity to buy these products when they have such a price discrepancy. So it's a beautiful hedge going into the election.
Excellent explanation, Jason. Yeah, so folks, just the long and short of that, even if you had a 10% hedge, let's just like kind of rewind the scenario to Q1. that 10% hedge did 1,100% return. Okay. So even if your 60% long position, right, got crushed, let's say 60% in that scenario, guess what? Your 10%, okay, hedge position offsets all of that and delivers a profit for you.
And it's also important to realize the further the stock market travels lower, the higher the probability that we suddenly have stimulus passed. So
Exactly.
there's very little that will scare us out of UPRO.
Yep. And YS Tong said question UVXY should be 30% on a $100,000 portfolio, or should it be 10?
Follow the trading plan, Tong. Yeah, you got to follow the trading plan. So I get a lot of questions from you wanting to alter the trading plan. All I'm going to say is don't alter the trading plan.
Yep.
So this is your positioning until stimulus is passed. Second stimulus is passed, we drop UVXY and we go long silver and short treasuries. And then we're off to the horse races.
Beautiful, Jason. Yep. Yep, that's what we do, guys. That's why our clients pay us a service fee, right? To structure the portfolio. It's where all you have to do is literally take seconds to replicate it in your account. Okay, but great questions, YS Tong. I love the questions coming in. So it's really kind of just reinforcing. You want to follow the design that we work so hard to create. Okay, and definitely understand. A lot of people try to alter and skew things, but really, guys, that's the entire reason why we design it. That's why we've had 80% less drawdown than the S&P, or I'm sorry, than the Dow Jones. Okay, coming throughout the period of, or the history of the track record, and we have an outperformance rate currently of about 39%. Right, follow the results, and you'll achieve that with your investment portfolio as well. Okay. Very, very cool. Okay, and so just real quick, folks, want to make sure you all responded to the poll. Some names in here I don't recognize. Alpha, make sure you responded to the poll. Andrew Bobrowski, make sure you responded. Let's see here. Dan Johnson, make sure you responded to the poll, please. Don, Frank, Galaxy S10, it's Dutch Hollow Sweets. Make sure you responded to it. Jan, first time I've seen you in there. Welcome in, and please locate the poll in the chat box there. Okay, Keith Milson said on the Mac, the poll just popped up in full size in the middle of the screen. No action needed. Neat. Thank you, Keith. That's good to know that. I did not know that, so I really appreciate that. Okay, LG Stylo 6. I'm not sure who you are, but if you can respond to the poll, please do so. It's going to be critical to the ending part of our presentation here. Okay, Lock Palumbo out in California. Please go ahead and respond to the poll if you haven't at this time. Mai out in California, please go ahead and respond to the poll if you haven't yet. Marcus, hey, how's it going, Marcus? Hope all is well. Let's see here. Mike, if you're into the presentation for the first time, make sure you go ahead and respond to that poll. Okay. Hey, Molly, hope all is well. Molly's one of our buy and hold customers. Natalia, welcome in. Thank you for taking the time to join us. Make sure you do respond to that poll. It's going to be critical for the ending part of our presentation here. Okay. And Pat, please go ahead and respond to that poll. Pedro Big, please go ahead and respond to that poll, please. And let's see here. We have a Samsung SN G9 35V. Please go ahead and respond to that poll. Let's see here. And Sobergen, please go ahead and respond to that poll. Soul, welcome in, and thank you for taking the time to join us. Please go ahead and respond to that poll. And I think that covers all of the people that I don't recognize as clients there, Jason. So I think we are good to go.
Okay, great. Okay, let's go ahead and start looking at more analysis. Okay, great. We have a message from Alonzo. Very good. Okay, so let's take a look at the markets, the news, and then we'll get you guys back to your normal day. Okay, so what we're looking at here are two of the leaders of the stock market during this 2020 wild. We've gone from a stock market crash to a new market, bull market. Now we're heading back into a very risky period because of the election. and arguing over how to spend deficits. And so what I have are Zoom, which of course is what we're on right now. Notice it didn't crash almost at all during the March sell-off and has just been rising rapidly. And then we have perhaps the biggest bubblish company, Tesla. And so these two have been tracking relatively closely. And it's really Tesla that fell off a cliff when it did its stock split, and then Tesla dumped 5 billion at the high. That created this recent volatility move. And so that's a big deal that Tesla has grown by 1,000% in the last about 13 months. And there's a lot of potential risk in this company. If this does sell off significantly, it does create volatility in the entire index. Okay, Shanae says, yeah, you want to be long UVXY now. And as soon as we pass stimulus, we want to sell UVXY and go long silver. Yeah, so we're already out of silver right now. Let's just go make sure everybody understands. This is all you should have, guys. This is very easy. Per $1,000, you have 10 shares of UPRO, 12 shares of UVXY, and 1 share of Moderna. So if you had $10,000, you'd have 100 shares of UPRO, 120 shares of UVXY, and 10 shares of Moderna. If you had $100,000, okay, so multiply by 100. Yep. Nothing else should be in your portfolio. Okay, so this is the very extremely safe way to head into the election, realizing that stimulus is coming for bailouts, and then secondary, we have infrastructure coming next year. So predictions have to be very bullish for stocks because of these two big spending plans. Now, for precious metals, we really want to see the spending to create the inflationary pressures. So we're waiting for a big spending bill to go long silver and short US Treasuries. Okay, so let's look at the markets. This is the breakdown of the S&P 500. And since the September sell-off began, what we're seeing is rotation. So we're seeing the market prepare for a reopening of the economy, a vaccine rolling out, and really a huge advantage in the S&P 500 compared to the NASDAQ. Now, I want to point out that it's not 100% that we're going to reopen the economy. I would really argue that the Trump administration is going to reopen the economy, get kids back in school, and have that as really the objective for 2021. The Biden camp doesn't want that. The Biden camp wants to reintroduce lockdowns until we have basically vaccinated the entire world population. And they do expect that to take a good year to get to the production levels to create 7 billion vaccines a year. So that's their plan, and they're not secret about it. They want to keep the country basically working from home and very limited opportunities for gatherings to occur throughout all of 2021 and into 2022. So Bill Gates really runs the show for the Democratic Party, without question. Everything he puts out, Joe Biden puts out about a month later in verbatim. There's no question. Okay, so with the Biden election win, we need to prepare for another global shutdown. And I would actually step out of the way of that with stocks and get ready to buy the NASDAQ as soon as we get a big crash and a big stimulus deal. Okay, with the Trump victory, it's clear. They want to reopen the economy, get the kids back in school. Much better reason to be long the beaten up portions of the stock market. So that's really the main decision there in terms of what to own in stocks. And so we can see it. What's the market preparing for? We're seeing technology take profits, and we're seeing the rest of the indexes have much less volatility. Okay, now if I come to this level, it's a little more apparent. So we can see basically Amazon and Apple led this decline, while we have banks and really everything else selling off about half as much. So we're seeing basically sector rotation and a prediction that the economy will reopen in 2021. So that's really the main decision you have to ask yourself for where to invest your money in stocks. Now, a lot of people like to look at what just happened and assume that's going to continue happening. So they look at technology outperforming and they say, okay, technology always is going to outperform. But this is really a historic opportunity to be buying banks, airliners, everything at over half off. So the SPY is my pick as long as Trump wins the election, which is my base case. If Biden wins, I do think we will have another pretty severe lockdown, and just look at what's happening in Europe, Australia, Canada, specifically Ireland, London, Spain. They're going back into lockdowns, and this is with cases, only with cases. They're scared of case counts. They're not scared of. There's no rush to hospitalizations currently, and there's no fatality. All those stats are falling off a cliff, so it makes no sense. So that's what we need to realize is a key risk based on the election. I don't think we're going to know who's won the election till December or January. So there's some pretty crazy things happening regarding that. Okay, so that's your decision. Do you buy tech or do you buy the entire S&P 500? Right now, our bet is S&P 500 is the better play. This chart, we have some of the best indicators, leading indicators to predict volatility. And I do think Zoom is important to add. So this right now is looking at Apple, Tesla, and a cryptocurrency called Ethereum. And so right now the signal is still up. We have Apple pointing up. We have, over the course of the last several weeks, Tesla still trading up, although it has sold off a little bit with a lot of disappointment regarding this battery day. Now they're hyping something new. And then we can look at the digital currency, and it's still stable. So right now, our best leading indicators are telling us that the sell-off is coming to an end and we are traveling higher. Now, while Tesla could create short-term volatility based on its market capitalization, okay, it's about the 10th the size of Apple. Apple can take the entire global stock market down in a heartbeat. So if Apple is selling off, we have to get out of the way. Apple is the most important company in the world, bar none, with over a $2 trillion market cap. So it's really important to see Apple stay above the most recent level it touched, which was that 104 level. If we see Apple, I'd really like to see it stay above 110 here on out. So keeping a close eye on Apple. It could have a little more volatility, but it's coming into its hot season. So is Amazon. Those are our two largest positions. Amazon, Apple, and Microsoft really make up the bulk of your portfolio when you hold UPRO. And those are great companies. They have monopolies. So we're not too worried about little bits of volatility and companies that have an absolute monopoly. But if they get lots of volatility, this creates systemic selling, a domino effect. Okay, so we don't want to get in the way of Apple if it starts to fall off a cliff. So again, I would suspect Apple is coming to its sell-off bottom and will lead the race higher to close out the year. And that's my base case. Now, could something very shocking happen leading into the election? Sure. And we're prepared for these shocks. Okay, so if we get the entire market panicking at once, we make the most money possible in our portfolio. So we actually don't mind black swans. Okay, so that's really what we're looking at from that perspective. Now, this is interesting. So we have Zoom racing higher today as Tesla is being sold off. So I'm actually looking at a little extra hedge this afternoon for our pro members to have a small but leveraged out of the money position with an extra little hedge for our pro members to be short Zoom with the puts. We're taking a look at that and seeing that typically when one of these sells off and the other doesn't, it leads to volatility in the near future. So it's not surefire trade yet, but that's something we're looking at for our pro members coming up this afternoon, which really makes sense, again, if you're in the $100,000 plus camp, to have these extra layers of protection. Okay, dollar is getting a strong bid suddenly, which is impressive, and actually what we would expect during a 10% sell-off in stocks. Is that sell-off over? Perhaps. Is the dollar rally over? Perhaps. Is this what's causing the sell-off in gold and silver? Yes. So we stepped out of the way of that. And again, the second we get stimulus, we can predict the dollar continues its decline. It very well may just continue that just from the current fiscal deficit, which is about 200 billion of a deficit being sold per month. But during the April rebound, it was closer to $800 billion deficits per month. So a dramatic drop in our fiscal spending is coming into the market right now, which is what's been driving all the data points to suggest a strong recovery. And I think we'll really see this data show up, not necessarily in Q3. In fact, we're expecting a massive 35% Q3 GDP print released October 29th. So that's about a month off. But it's really Q4 where I think we're going to see the drop in fiscal spending showing up in the corporations' P&Ls. So we do need stimulus. That is critical. This is the stock market against the treasury market. We love the treasury market, but when the Fed went and manipulated interest rates to be lower than they should be during this recovery period. So let me zoom out so you can see this. So most investors are half stocks, half bonds, treasury bonds, long duration, and it makes it very safe to play the markets with no hedges. The treasury position is your hedge. But when this happened, when stocks rebounded and treasuries rebounded at the same time, we knew that one of these were incorrect. And which one did the Fed manipulate? Well, they manipulated the treasury market to stabilize the ability for the US government to borrow. And so we predicted that the treasury market would no longer provide a hedge for stocks. And we got investors out of treasuries after about a 3-year hold right around here. And so sure enough, in this most recent sell-off, we had about a 10% decline, a little less in the S&P 500, and treasuries did nothing. So not only is cash trash, treasuries are now trash as well, especially when we look at the inflation rate compared to the interest rate paid. It's a negative return. You're actually going to lose money lending money to the government, and you're not going to hedge your investment. So it's absolute sham to buy US treasuries, probably for the next 3 to 5 years, unless the Fed allows interest rates to rise rapidly. So we're going to take a look at what the Fed can do to protect the treasury market while we need to borrow trillions of dollars for the foreseeable future. Okay, so here are the 3 big markets, the S&P 500, the NASDAQ, and the treasury market. You can see treasuries are most likely going to trade flat or down for the foreseeable future. And the only decision really for investors is how much of your money should be in stocks versus commodities. And then when you're in the stock bucket, should it be playing the beaten up portions of the economy, predicting a recovery and a removal of all these policies? Or are we going to remain locked down into 2021 and really benefit a handful of technology companies? And so I'll tell you, it's Trump, you want to own the SPY. Biden, you want to own the NASDAQ. It's really that simple. And that's because I'm predicting the virus is really not a threat like we thought it was. So we were pitched this was going to be like the Spanish flu. There are going to be tens of millions dead. And it ended up being about 90% less fatal than we thought. And so none of what's happening right now makes any sense. Now, this chart, we're looking at treasuries against gold. And I've been predicting that gold was going to have a sell-off and got our investors out of gold and out of silver, and just in the nick of time. So we're seeing a lot of pain in precious metals. And again, I love precious metals, but not until we get that stimulus. So we need the stimulus. We're going to be right back in silver instead of gold. There's a lot more upside for silver. Okay, Wells Fargo is a large US bank with the most commercial real estate at risk. So first it was well, right now the big threat are hotels. Something like 2/3 of hotel owners say they will go bust in 6 months if people don't start aggressively booking hotel rooms. Okay, the same thing is true for the airliners. They're on the verge of bankruptcy as well. They're looking for a $20 to $30 billion bailout right now. Okay, and so what happened with Buffett? He sold Wells Fargo completely. This was his favorite little piggy bank. Okay, so it takes a lot for Buffett. And in the last crash, guess what he bought? Wells Fargo. So why is he getting out of that position today? So this does remain a key bank to focus on. And we got to realize, who are Buffett's really insiders that give him advice? Well, there's really one person that he's been best friends with his entire lifetime, and that's Bill Gates. What's Bill Gates predicting? Lockdowns until 2022. What did Warren Buffett say during his recent shareholder meeting? He said he trusts Dr. Fauci. So we got to realize he has massive insider knowledge of what's going on, and he is worried about banks and he's worried about airliners heading into 2021. So without the bailouts to those two industries, they're in serious trouble. That's why they're priced so cheap and have the best potential return ahead. Okay, so Wells Fargo could very well double in the near future if we do reopen the economy and save all of the loans that they have on their books by getting people back into their jobs and making their payments. Another bank that is looking very worrisome, less so than Wells Fargo, is Bank of America, another position that Warren Buffett reduced. Now, this is not trading anywhere near the level that Wells Fargo is compared to the 2008 crash or even the March crash, but it's also not showing strength, is it? So they're all counting on more stimulus. Okay, oil, great leading indicator. Oil predicted the March crash in January, and that's because China stopped buying oil as they were preparing for lockdowns. Okay, it predicted this recent sell-off. Okay, but right now it's predicting that we have higher highs ahead. As long as oil's over 40, we're very bullish on the outlook of a recovery. Okay, Europe is looking weak. So this is the European index, and looks like there's some major issues in the banking system in Europe and Asia. And so we're seeing this with most of their large banks going to very low price levels. And they're also fighting negative interest rates in Europe, which is really awful for banks. So this index is showing trouble ahead and is something to be closely monitoring. So it's had a very good rebound from March, but it's petering out. Okay, what about Asia with emerging markets? It's showing a lot more resilience. And again, we're really counting on Asia to get past 46.35 and EEM and to remain above that level. And there's actually a good likelihood that emerging markets could give the S&P 500 a run for its money into 2021 if China avoids a major conflict with the United States. And that's a big if. So that's the big risk if Trump wins, is that we're likely going to get very aggressive with China not playing fairly in the world economy. Okay, this is the VIX futures contracts. This discrepancy is a huge opportunity for us to hedge with UVXY heading into the election. It could go up with stocks. So that's what we saw yesterday. Copper to gold ratio indicates predictions in interest rates. If we have rising interest rates, we're going to predict higher stock prices. So in a world where we're buying copper up faster than gold, that's indicative of building growth recovery. Okay, it's the early stages of a crisis where gold tends to rise faster than copper. So copper is becoming a very attractive commodity to own in front of a recovery. So I like a company called Freeport-McMoRan to be long copper. But I'm not quite sure we're at the end of the debasing the currency period and really going into the true growth period. So I still like silver over copper in this early recovery stage. And again, we're waiting for stimulus, but bottom line is we're predicting inflation with this chart because copper is rising faster than gold. Now, with the sell-off, we would expect that the yield curve should be getting suppressed lower. It's not. So we're actually seeing interest rates rise Okay, so that's really one of the biggest trades of the next decade, is to short the US Treasury market. Now, the Fed's going to fight the Treasury market crashing. They don't mind a slow rise in interest rates to become attractive and competitive, really, with China's Treasury product paying out 3.8. We're paying about 1.4. So they're paying almost 3 times what we are to loan the Chinese government money compared to the US government. So what did we get with the 10% correction? We got rising rates. So that's beautiful for what we're predicting, which is, again, that the Fed's going to suppress interest rates but allow them to slowly rise. And again, that becomes extremely bullish for stocks. So here's where we track the debt issuance. So this doesn't mean we're going to spend the money, but we're going to collect the money. So the US Treasury has $1.7 trillion in the coffer, and they need to spend it. They're desperate to spend it. And again, I think they're going to try to figure out how to get a stimulus check out with an executive order if we can't come through with some sort of package from the House that the Senate will approve. So right now, they've been grappling over about $1 trillion discrepancy, and now they've actually cut it down to $700 billion. So Nancy's offers 2.2 trillion. The Republican Senate is offering 1.5 trillion. So they're getting closer. And the longer they squabble over this, the bigger the price tag of the stimulus has become. So you're getting rewarded to hold through this period of risk, but we gotta not kid ourselves. They have to pass stimulus, otherwise they're going to lose their job. Everybody's going to vote those folks out of office. So we've got decent issuance this week. It was about 310 billion being sold, but that's not getting spent. So it's one thing to collect the money, it's another thing to spend it. The fiscal spending is really the impulse that's been driving stocks so high. It's not just people predicting that stocks must go up because there's quantitative easing. The data is really suggesting a very fast recovery. Okay, but that data point is going to be hampered if the government stops spending. In a normal year, the US government's about 16% of our GDP, maybe closer to 20%. And this year, because of policy to lock down the country, it's closer to 30% of our GDP. So the government must keep spending and handing out freebies and bailouts until we have completely reopened the economy and changed consumer behavior. So we're stuck. We're stuck spending, and we may be stuck through the election, but that's not a guarantee. The Democrats have the worst statistics. So if we look at the Republican states compared to the Democratic states, we'll see two basic trends. One is that the Republican states have far less deaths per million and related to the virus. Okay, they did the least lockdowns and they ended up with the best statistics, without question. The other thing you're going to find between these two groups is that one has about double the unemployment levels currently. So most of the red states are sitting at 4 to 5% unemployment, while most of the blue states are now well over 10%. So it's just a horrifying mistake that many populations have made and continue to make relating to how to deal with the virus and how to protect the economy during that period. So the Democrats really desperately need money and bailouts. So I do think that it would be very risky for them to not pass a stimulus deal in the near future, especially when we have debates coming up. And those debates are in less than a week, 6 days. Okay, this is where we get the announcements of QE. We can't do more QE if the government's not going to ramp up spending. So really, this is the most important page to look at each week. They tell us ahead of time how much quantitative easing is coming through. And if this were to drop, I'd want to be long treasuries. And if this stays at this level or rises, I want to be long stocks and precious metals. It's really that simple. So you basically want to own the asset the Fed's not buying. If the Fed's buying treasuries, you want to own stocks. If the Fed pulls back all the support, then you want to own the treasuries. So we can cover that when the time comes. I'm predicting we're going to be seeing $80 billion a month treasury purchases for the foreseeable future. And their wording was that we will do at least this quantity or more. So they have not indicated that there is any possibility of them reducing quantitative easing at this point in time. So that's really what we need to know. The last part of the puzzle is get the government to agree on how to spend the money. Okay, repo market is another form of quantitative easing. This is really off the table currently while we're in QE, so no need to look at that currently. The balance sheet's growing at the fastest pace in history. So you got to realize what this really means is your dollar is worth less. There's more dollars fighting over a limited supply of goods and services. And it's funny how inflation works. One person gets a purchase and that price has risen. So that person reflects that into all the products he sells. And then those people buying that person's goods and services have to reflect. So it becomes this domino effect. One price raise creates 2 price rises, creates 10 price rises. All of a sudden you get runaway inflation. So that's what's coming, and it's impossible to prevent. We have devalued the dollar at the fastest pace in history. Now it's just a matter of getting those dollars to start pinging around the economy quickly. And so we're stuck at 0% rates for the foreseeable future, and we're stuck in quantitative easing for the foreseeable future. So bottom line is you don't want to own stocks, you don't want to own treasuries. You have 2 things to consider: tech stocks or the S&P 500. NASDAQ or S&P 500 is one question you need to ask yourself. The second question is, do I want to own gold and silver, or do I want to own copper and oil? And I will tell you, if you think we have a hot economy, you should be in the oil copper camp. We're not there yet. Okay, we still have 20 to 30 million Americans without a job. It's when we start to see the transition and the full reopening that we want to get a rotation out of silver and into oil and copper. So I think we're going to be seeing the big melt up in gold and silver in the next 12 months. And then we're going to see the true recovery and big melt up in commodities that are actually inflationary, like oil and copper, after that. So expect that to be our portfolio moves. Step 1, wait for stimulus. Step 2, drop your hedge, go long silver. Step 3, watch silver melt up and then begin to rotate into oil and copper. So that's what I see coming down the pipeline. Now let's talk about some problems. What stops the bubble? Okay, so it's going to be runaway inflation. When can we expect that to really occur? So I want to go back in history. Last time we were doing policy like this and managed to get our debt load this high was in World War II. So right out of World War II and into World War II, the Fed had to do the same thing. We had to have the government spend a lot more money than it has. And we had to use the Federal Reserve to essentially buy the US debts. Okay, they called it yield curve control. And so we're doing the same thing. So look, in the 50s, we had to go to 0 rates twice. During this period, we had massive handouts and freebies to all Americans. Okay, so it works until it doesn't. From 1945 to 1965, you have a massive stock market rally. But it all comes to an end when runaway inflation and eventually hyperinflation nearly crashed the US economy. So Paul Volcker had no choice. He had to hike interest rates first to 9%, pulls them back. Runaway inflation came right back in. Then he goes even higher. He goes up to 13%. Okay. Inflation crashes, but then it comes roaring back, and he had to go all the way up to 19% interest rates. So this crashed the US stock market for 15 years, as well as the US bond market. Okay, so that's what's going to come next, but we're probably a good 5 to 10 years away from that period of time. So it'll be fun. There's a lot of money to be made shorting markets, but we're just nowhere near that period. Right now, we have so many people unemployed that there's very little risk of inflationary pressures yet. This is the Fed's balance sheet, which we watch every Thursday. So tomorrow we'll have an update. Friday we'll cover it. Bottom line is they're just buying lots of mortgage-backed securities and US treasuries, and they're going to continue doing that. So I think we'll see the balance sheet at the current pace grow by about $1 trillion per year. If we get stimulus and infrastructure next year, it'll probably grow by 2 to 3 trillion a year to be able to fund that. Now, this is the main thing to keep an eye on, is the So let's just look at this. So the 30-year treasury pays you 1.4, but the inflation rate's 1.7, at least by what bond investors look at. We all know the real inflation is far greater. Just look at the value of houses doubling in the last decade. Look at the value of stocks more than doubling in the last decade. All financial assets are showing the true inflation rate. Then look at food. It's just endless. We know that our dollar is not buying the same goods it bought just a year ago, and it sure as hell isn't buying the same goods from 10 or 20 years ago. And that trend is going to get worse because of where we're at in the business cycle. So for precious metals to take a profit and get out, I think we're a good year or two away. And the main thing to watch is when the inflation rate is less than the treasury interest rate. So when the interest rate becomes positive compared to inflation, treasuries are an extremely sexy investment. It'll crash precious metals first. And if these interest rates get too attractive, it can crash the stock market second. Okay, so we're a long ways away from worrying about that. And the Fed, with its QE, is going to slow the rise of interest rates by design. But we still have to compete with these Chinese. So they are paying 3.8, we're paying 1.4. So let's take a look. I'm going to go ahead and hide the Chinese interest rate. And I want to look at what we're expecting. So this is an effect of quantitative easing. It gives stocks an unfair advantage, and it makes interest rates rise despite the Fed buying treasuries. So it's completely counterintuitive. But we can see that when there is a period of recovery and the Fed has to manipulate the bond market and protect it, we can typically see interest rates nearly double. So in the 2009 recovery, we went from 2.5 to 5. Okay, we're at 1.4. I don't think we go above 3. Expect our portfolio to start dabbling in treasuries around 2, get aggressive in 2.5. If we hit 3, we're all in. Stock crash is nearly guaranteed if we get to anywhere near that interest rate level. And again, I do suspect that is a long ways off. So we're going to be playing this with the triple T. The second stimulus is passed, we're going to get a great big smile on our face and realize treasuries are headed much lower because interest rates are rising. And the best way to play that is with the triple T ETF. So again, the only way the Fed prevents that is ramping up QE, which makes inflationary pressures grow. Great for stocks, great for silver. So at the right time, we'll be long silver and short treasuries instead of so long the UVXY position. Okay, Deutsche Bank is a German bank with massive derivatives. It is a systemic risk to the entire financial system. These levels are very risky. So probably a lot of we gave central banks trillions of dollars during this crash. And I would believe much of it went to Deutsche Bank to secure its derivatives that were probably underwater. So this is a good bank to look out for risks. Right now, it's not screaming massive problems. HSBC Bank is. So we don't know exactly what's going on. Why is this bank selling off so viciously right now? Below 19 is a problem. So I'm waiting to see this get back above 19. The smartest way to play that risk is to short the Hong Kong peg. So that's a Forex trade. We are interested in shorting the Hong Kong peg and the Chinese yuan as the two main Forex plays. And that's a more advanced play. So I teach that in what we call our Bootcamp on Thursdays. So we're currently shorting the Hong Kong peg with 1% of our portfolio. And this has the potential to double your net worth. If this peg snaps because US and China go to war, which could possibly happen with the Trump administration, the opportunity is for this to go from 13 cents to the dollar down to a penny in a heartbeat. So this is, if you've watched Kyle Bass, that's what he doesn't tell you how to do it. It's easy. We teach our clients how to do it. It's one of the safest trades in the world because it's pegged at 7.75. It can't move against you. In fact, all it can really do is go in our favor from here. So that's another additional hedge that is really a beautiful play. Now, the yuan is what you want to do when Trump puts tariffs on. The Chinese try to offset the effect of tariffs by devaluing their currency. So it works, but it hurts, of course, the the Chinese people, which of course they don't care about. So second, we see Trump say the word tariffs, we want to short the yuan. This is a bread and butter play for the next several decades. I do think that the Chinese currency is about 3 times overvalued. So we have probably about 10 hours of content related to Hong Kong and China that you do get instantly when you join our boot camp. And I can show you just how crazy these Chinese are. So you look at this massive GDP growth. It's a tale of two stories. They have a beautiful business being the manufacturer for the world. Okay. That's how they print about $1 trillion a month. And they tax their citizens that's at about 50% plus another 20% for all the different social security and housing related benefits they provide their people. Okay, so they're paying these guys about $10,000 a year to sit there and manufacture Apple iPhones, tax them at over half, and they can concentrate all that wealth, and then they try to use a centralized economy to spend it. And that's where the Chinese have bad asset allocation. So they're busy building up a bunch of crap that nobody is using. They've built over 100 million high-end condos that are just crumbling all over China. They build billion-dollar airports that next to a perfectly fine airport. So it's the typical misallocation of capital that you see in a socialist society. So just look at the Cold War with Russia. We're basically going to try to collapse China and prevent them from taking the lead in the next decade. And that's really what we're seeing play out in slow motion right now. So the bottom line is the Chinese yuan will likely travel from 7 to 21, and you're going to make a lot of money shorting that currency. But we need to play it carefully because the Chinese manipulate this currency like crazy. And we want to short their currency when we know it's in the Chinese interest to devalue. And the time to devalue is when America puts tariffs on their currency. So that's this move of strengthening the yuan is beautiful for our clients who are preparing to short this currency. I think it'll be a December, January play. We want to get through the election. I doubt there will be any aggressive moves by Trump that could create stock volatility ahead of the election. So that's coming in soon. Now, this is the big Spanish bank that's falling off a cliff. This is the scariest bank. We're seeing a lot of problems in Europe, and primarily because of negative interest rates. So, and plus, what is Spain, France, the entire UK doing? They're going back into a lockdown that is suicide for your economy and for your banking system. And there's really no reason to be doing it. So this is very frightening to see that they're self-inflicting this pain when there's really no argument for it. Okay, here's the S&P 500. And again, if we get a March crash, you are rich overnight. So you don't have to worry about big crashes in our product. But let's just look at what does the stock market do and why does it do it? Well, it mostly goes up. Is that because these companies are becoming so much more valuable? Did the S&P 500 really deserve going from in just under 3 decades? Did it really go up in value by 700%? Or did the purchasing power of the dollar decline that much? It's a combination of both. So it's really stupid to be invested in cash and treasuries. It's very smart in the long run to be invested in stocks. Okay, here's the UVXY. Again, we've just shown you the 1,000% return in March. Now that was a very sharp sell-off. That's how it did achieve that. There's different potential outcomes for UVXY. But the short-term outlook is very bullish just based on the structure of the futures contracts all the way to January. So I'm actually expecting UVXY is going to go up with stocks into the election modestly, unless we get a vicious stock crash. And then I would expect it to go up aggressively. Okay, TLT and the dollar, highly correlated. Bottom line is there's an endless supply of treasuries. There's an endless supply of dollars because of this treasuries. And so that makes these two lose value over time. It's a horrible investment. You don't want to be long dollars when we're printing money at the fastest pace in history and the government is trying to bail out everyone. So I think that's pretty easy for everyone to understand. Here's Moderna. We played phase 1, made good money, played phase 2, made good money. And now we're playing phase 3. So I expect a similar outcome. I do expect us to break above 100 on Moderna. there's risks. If the vaccine fails and kills people, this stock is going to crash. Okay, so that's why we have the right exposure to Moderna. We're not all in on any one company. Here's the first play we want to capture in the next precious metals melt up. And so silver went to 45 in the last QE period. I think it's going to go well above 45 this time, maybe above 100. And so AGQ gives you 3 times leverage on that play. It's beautiful. We're going to be buying AGQ the second stimulus comes in. And here's the that big rally where it traveled up nearly 100%. Let me go to a weekly chart. And so you can see that massive run up. And so I'm actually expecting at least twice, maybe 3 times run up in silver based on how fast, not just the US government, but every government around the world is in a currency war right now. So now is really a great time to be long those precious metals after the stimulus comes in. Okay. Without the stimulus, it's not the right bet. Let's go ahead and take a quick break for any questions. And
I'm so proud of you guys. I'm so proud of you. And
let's go ahead and take questions now.
Very nice, Jason. And so anyone that has any questions, please feel free to jump in. Okay, whether you are a paid client, whether you're a trial, just jump in, folks. One of the awesome benefits that you have, during your experience with us as a client, or also during your experience with us as a trial member, folks, jump in there and ask questions. Right, this is one of the few experiences that you'll have in your life where you get to ask questions to a chief investment officer daily. Okay, so take advantage of that. Jump in there and ask questions. Okay, so a couple new people I see in Ahmed Hanafi, welcome in, Ahmed. Please feel free to jump in there and ask any questions you have. You can do so by either raising your hand or by simply typing into the chat box. Okay, and guys, I'm going to go ahead and place some basically some directions there in the chat box for you. Okay, so welcome in, guys. And if you have any questions, please simply raise your hand if you want to speak live, or simply type them into the chat box. Okay, and we'll be more than happy to address those questions, help educate you, right? And I know Jason covers a lot of material, okay, in a short span of time, but that's why we're here, guys. Just feel free to jump in there with any questions you do have. The more questions you ask, folks, the better you're going to understand what we're doing and why, and the better your knowledge base is going to expand today. Okay, and that's going to help you long term, right? So jump in there with any questions you all do have. Okay. Let's see here. Angels 7ek says, would you use long option calls for UPRO or the actual stock?
Yeah, follow the trading plan. So if it's not on the trading plan, I don't recommend it.
So the answer would be no. So, and it's good to know too, Angels 7, that it already is a leverage product. Okay, so yeah, call options wouldn't be a good idea to add to a product that's already a derivative. Okay, so very nice. And I know, Alonzo, you're trying to get some more capital together, bud. Okay, cool. But yeah, just whatever capital you do have in tranche and scale, Alonzo, just follow that with a trading plan, bud. Okay. Let's see here. Ahmed, any questions? Alpha, any questions? Andrew Bobowski, any questions? Let's see here. Clayton Weller. Hey, Clayton, welcome back. I know you've been here pretty religiously for the past week or so. Please jump in, ask any questions you have under the sun, Clayton. Okay. Like I said, the more questions you ask, the better the value you're going to receive from us. Okay, David, jump in there with any questions. Don, jump in with any questions. Frank, jump in there with any questions. Galaxy S10, Dutch Hollow Sweets, jump in there. Any questions you have, guys, jump in there, please. Let's see here. Julio, one of our buy and hold clients. You have any questions today, Julio? Let's see here. LG Stylo 6. We have in Marcus. Marcus, if you have any questions, jump in. Mike, any questions, jump in. Hey, Molly, hope all is well. Any questions, as always, go ahead and jump in there, Molly. Natalia, welcome in. I believe it's the first time I've seen you, so jump in there and ask any questions that you do have. Okay. Pat, believe you're new here, so welcome in. Thank you for taking the time. Feel free to jump in with any questions. Pedro Big, please go ahead and jump in there. I know you've been religiously, joining us for the past week or so, so feel free to jump in, guys. Let's see here. We also have Robert Christie up in Canada, one of our newer buy and hold members. Always has had great questions so far. Please feel free to jump in with any questions you have today, Robert. Let's see here. Samsung. Sass, Soul, Susan. I believe Susan is. I believe Susan joined us yesterday, so welcome back, Susan. Okay, Van, if you have any questions, jump in there. And YS Tong, great questions earlier. If you have any more, please feel free to go ahead and jump in with any questions, folks. All right. And don't be shy, guys. Certainly take the time to unmute your microphone. Okay. And we love to interact live with you guys. Asking questions by unmuting your microphone is always the best way to truly address questions and work through those with you. Okay. And let's see, Alonzo said, thank you guys. You're truly angels and doing some amazing things to help people. Can't say that enough. Hey, thanks, Alonzo. Appreciate it, bud. We love what we do. And it's just so cool the educational factor, right, is neat because then you guys can teach your kids and your grandkids, right, what's going on in the market. Okay. And the profit part of it's great. But the education is really cool because that's something you can pass on. Okay. And I guess technically the profit side of thing you can pass on as well. But it is neat to educate your kids and your grandkids too. Okay. Mike says, do you see BTC S&P 500 correlation separating anytime soon? So is a correlation with ETC and the S&P 500 that Jason mentions. Okay. And anytime soon in Bitcoin increasing significantly. So great question, Mike. Jason, do you want to go ahead and take that, bud?
Oh, sorry. Can you repeat that? I was looking at a option trade for our pros coming up here soon.
Yeah, Mike said, do you see Bitcoin / S&P 500 correlation separating anytime soon and Bitcoin increasing significantly?
No, I think they will be correlated for the rest of their history.
Okay. Yeah.
So I would rather play silver than Bitcoin.
Yep.
By far. So we're actually seeing the central banks are all rolling out their own cryptocurrencies now. So the Fed's about to roll out a coin where they're going to be able to give everybody direct deposits. But that said, I do think Bitcoin's going up, but I would much rather play it in a regulated market like the stock market. So silver. So AGQ is basically buying options and futures contracts on silver. So silver and Bitcoin are extremely correlated. But one, again, is potentially outlawed by governments, and the other is actually bought by governments. So I would rather own silver over Bitcoin or Ethereum, even though I track those as a great leading indicator. But yeah, we can express the same prediction by going long silver and have a lot less risk. And so if I was some rich, if I was super rich and I lived in a very oppressive country like China or Iran or something like that, yeah, I'd be trying to sneak my money out of my local currency into something I could hide, like Bitcoin. Okay, so that's when I would be really interested in that asset. But if I'm just a law-abiding American, I'd rather have 100% guaranteed, federally secured and insured investment. So silver. Okay, so those two are very tied together. And we've made a lot of money. I've personally made a ton of money in Bitcoin, Ethereum, Ripple. So it's not like I'm anti digital currency. But yeah, no, you're going to make more money with less risk going long silver. And then after that, going long oil and copper, as soon as we have a real recovery. But yeah, we're looking at a option for the pro members coming in. So if anybody wants to get that, that's coming in soon too. Mike says, what about a small Bitcoin investment as an asymmetric bet? Yeah, I love asymmetric bets. All that means is you stand to make much more than you stand to lose. And so, yeah, silver is your asymmetric bet. Today we're going to put out a put option on Zoom. That's an asymmetric bet. So yeah, we love asymmetric bets with small amounts of capital, like you've said. But what would you rather have, Bitcoin or silver? Silver, no question. No question. Now, if I was some sort of outlaw, or if I was in an oppressive country and I wanted to hide money for long periods of time and be able to get it cross borders, yeah, okay, Bitcoin has a big advantage there.
Yep.
Is
Makes
it
a
going to
lot of
out?
sense for the criminals.
Yeah, and can I buy or people who are living in oppressed dictatorial countries? Okay, where
Absolutely.
they may just, in Russia, they'll take your wealth away in a heartbeat. Same with China. So yeah, there's good reason for those products. But if you are in a country like the United States, what's the smarter move? I'd say get very aggressive with silver. That's my favorite play for that.
Okay, very nice, Jason. Okay, and wonderful, really insight and explanation on that. And you guys, there's so much crap that out there that hypes Bitcoin going to $1 million. Just stop listening to them. Right? It's the best thing you can do for your money. Okay.
And yeah, you got to
Let's.
realize as the market cap matures in Bitcoin, the relative returns are going to slow down. The same thing is true for gold and silver and everything else. So yeah, silver. Just think of silver as your play in that same idea. Um,
Yep, and the
but yeah,
government actually buys it, just like
we're
you
going to
said.
play a melt up in silver first, and then we're going to play a melt up in oil and copper second. And it's just that simple. That's what you should expect. I'm gonna guess the silver melt up is going to last 1 to 3 years, and then during that period, we're going to want to take profits and get long oil, because oil could go much higher, as well as copper, because again, the entire world. It's not that oil and copper is suddenly more attractive than it was yesterday. What's happened is there's more fiat currencies fighting over a limited supply of goods and services, basic economics, right? So we're in this deflationary stunt of economic growth because everybody's scared. They think they're going to get sick and die. We got idiots walking around outside with masks, okay, by themselves. In fact, we have the Democrats pushing this hard. Look at what on earth is she wearing a mask for up on a stage by herself?
You are phenomenal.
Why in the hell would she do that?
I'm so honored to see you in person. I watched you on TV.
Okay, because they're trying to scare people. They're trying to scare people. Okay, it's really sad, but there's a group of people in America who love the oligarchy of China, and they want to make that happen in America. They want to control the American population and the American government. And so we're seeing the Civil War break out right now. So yeah, we're in a small period of deflationary that's being offset by fiscal. And so the second we get that fiscal ramping up, we will play silver, and we're going to make a lot of money for you with that. But you got to wait. And look, I predicted pain in precious metals, and it's sold off viciously. We got our clients out of gold at, what was it, 2,100 or 2,200, Dean?
I think we were just shy of 2,100, but it was within a day of the peak this year. And the model portfolio with the pro portfolio made
And we
60
were
grand.
leveraged in gold. We were playing UGL, so we were leveraged in gold during that melt up.
Yeah, it was a $60,000 profit in 2 or 3 weeks, off the top of my head.
So don't worry, we're not going to miss out on the crypto precious metal melt up. Okay, that won't happen. What we're going to do is help you time it so that it's virtually impossible to lose. You want to make no losses in a very risky. I mean, think about it. Does gold generate income? No. Can it hold value? Sure. So When do we have to worry about fiat currencies holding value? When we're ramping up the printing of them. So that's a ways off. And second, we get stimulus through, we want to go long silver. It's really that simple. In the meantime, let's look at who makes money. Who makes money? S&P 500, they make the money. So we want to have our stake in the top companies that make the money. Now, again, if Biden wins, you're going to go into a lockdown. That's going to crush the stock market again. And then they're going to come in with massive stimulus, and it's going to all benefit the tech giants who control the Democratic Party without question. Okay. Trump is more backed by Wall Street. Wall Street is financing all the companies that are really beat up right now. Okay. So with the Trump victory, now we're concerned about war with China, but we want to be long the beaten up portions of the economy. So all these companies are just selling at half off right now, have the best potential return. So at this point in time, the safer investment is to be long the S&P 500 versus the NASDAQ. It has better risk parity comparatively, has more diversity, it has more value, a little less growth, still has all those top FANG stocks. We're not missing out on the big tech. Okay, as soon as we get through the election, it's also easier to hedge the SPY because we can get the exact asset that correlates to it with UVXY. So it's really a beautiful combo. UPRO with UVXY. It's a very beautiful combination. We will slightly diversify it as soon as we get the stimulus through by shorting treasuries and going long silver. And we'll most likely we'll probably reduce UVXY down to 10% as soon as we get stimulus, and then replace that 22%. Half of it will likely be long silver and half of it will be short treasuries. And we have a beautiful positioning into the next, I'm guessing, about a half decade of very little risk, because really our fear is the treasury market becoming too attractive. And I don't think it's going to become too attractive till it gets to around 2.5 to 3. And then that'll crash everything. Second, that gets to those levels, that will crash stocks. First, it'll crash precious metals. Then it could potentially crash stocks. And so we will aggressively buy treasuries as we breach 2, then 2.5, and then I don't think it'll go above 3. And so that's a whole discussion, but we can see what's the path of treasuries over the last 40 years. Well, it's just lower, 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 which means the value of treasuries go up, up, up.
Excellent, Jason. Very, very nice.
Mike says, what if
Okay,
the government confiscates silver? Yeah, so yeah, that was a famous period of time. And yeah, I don't think that's going to happen. But yeah, I'm aware of that. Central banks are aggressively buying up precious metals right now. And they're not in a period where they're afraid to use monetary policy like they were in the Great Depression. So that's a very fun story. I'd highly recommend you go look at that history when they outlawed gold. So yeah, we're aware of that period of time and not concerned about it. It's actually looking like the Russians and the Chinese are going to try to back their currencies with gold and get off the dollar standard. So they're starting to trade with one another. They're aggressively buying gold and using that to protect their currency. So I think we're headed towards a period of time where, and who owns the most gold in the world? The United States. If you look at the big deficit we just had, most of that trade deficit was actually from massive play in massive imports of gold. So it wasn't like we were getting ripped off with trade with China or something like that. It's that Americans are massively accumulating and delivering gold. And so now it's really the bigger risk with the precious metals market is there's not enough gold and silver to match the assets under management of these ETFs. So we could actually see a huge spike in prices due to big players starting to demand delivery through the futures contracts. People don't realize when you buy a futures contract, you can demand delivery of those products. And there's just not enough gold and silver to go around for all the money floating in paper products. So that's actually potentially something to be concerned about, which is bullish. So it's bullish. This could cause these to just skyrocket. So yeah, I like to be long silver. I think we have that pretty clearly outlined. Time wise, look, we just sidestepped almost a 20% pullback in silver. So our entry point is going to be beautiful when I tell you to pull the trigger on that one.
Okay, great. And Jason, let's see here. We had a question from YS Tong. It said normally UPRO versus UVXY are going two different directions at the same time. What would that time, what that be times both going up or going down at the same time? So I think basically what they're trying to ask is they typically go in different directions. What would cause them to move together?
Yeah, so as we approach, so we're trading at 25 on the current month and 30 on the next month. So as we approach October, I'm expecting this to jump to close the gap. And that's regardless of what the stock market's doing. So you can see that happen right here. And I believe it will happen. And it's real simple. Market's hedging heavily in October, November, December, all the way through January, but they weren't hedging September. So to buy UVXY today is cheap. It most likely won't be cheap as we approach these risky periods of time. Now, the stock market falls off a cliff, UVXY skyrockets, but there's a good chance it goes up with stocks until we get some sort of panic, which would be something the market's not expecting. So yeah, you're very safe. You have 30% of your account protecting to the downside into this very risky period of time we're entering. And we very well could just see stocks rally all the way through the end of the year, and the volatility index is going up because of all the hedging happening. So unless something shocking happens, there's a good chance we can travel higher here. Now, again, what's the big risk? The government not printing, or rather spending money so that the Fed can keep printing. That's the big risk in the short term. All right, Dean, I'm going to have to hop off now to prepare for the next webinar and get the pro members a trade update.
Okay, sounds good.
The
right,
Russians were working with Hillary, which is funny, and that's all coming out. Yeah, so I think a bunch of the Democrats are going to go to jail for spying and creating a bunch of fake reports to get FISA applications. So yeah, I think there's a lot of the establishment really getting exposed here. That could be one of the big shocks to the market here. So yeah, keep a close eye on that, which I do. So yeah, I follow politics very closely here.
Very nice, Jason. Okay, cool. Very nice. We'll let you go ahead and get that trade alert ready for the pro members there, folks. Okay, and if you do have over $100,000, that is certainly the membership that you may want to consider, and certainly the portfolio structure and system that I'm using with large sums of my own capital. Okay, so very nice, guys, and look forward to that trade, Jason. Thank you, sir. All right. Awesome, guys. So I'm going to go ahead and transition over to my screen here. We're going to cover a couple more things. And folks, if you haven't yet, please click on the poll icon that is in the chat box. Go ahead and get that filled out for us. Okay. So very nice. And I will go ahead and post some instructions on how to locate the poll in the chat box, guys. And also just to locate the chat box actually in your in your Zoom screen, is simply scroll to the very bottom of the screen. And when you do that, a gray bar will pop up. Okay. And then you simply click on the poll icon. Okay, but I'm going to go ahead and post some directions in there on how to do that as well. Just so not only do you have the verbal, but you also will have written out instructions as well. Okay, guys. And just real quick, a couple more things I'll post into the chat box there. Okay, there's going to be the link to get everything built. Okay, and Mike said, great webinar. Thanks again. Very nice, Mike. Appreciate it, bud. Okay. Very good. And also, you have your instructions posted into the chat box. So there's going to be some helpful instructions and links in there so you can go ahead and get started. Okay. And get the portfolio built out today if you haven't done that already. Okay. And I will go ahead and transition screens here, folks. And we'll start with the latter part of the presentations here. All right, guys, and this is all dedicated to everyone that is on a trial currently. Okay, so clients, thank you so much for joining us here today. We'll see you tomorrow. Trials have some more great information for you, and we'll kind of walk through a couple really neat things and kind of explain why we filled out that poll. Okay, and so it'll kind of connect the dots for you. So want to welcome and thank you for taking the time to join the investment webinar. Enjoy the educations and enjoy the education and please ask questions along the way. We truly appreciate your time and attention to show you how boring successful trading can be when you actually have the right strategy. Okay, make sure to save my number and call me or text me with any questions you may have. Okay, it's at the top of the screen here, guys. And if you want to just shoot me a text and say, hey, Dean, this was, whatever your name is, I was in the webinar today. I'd like to chat later. Please feel free to do so, folks. It's 505 322 7515. Okay. And just please go ahead and feel free to text me at any time. And then that way I know that you were in the webinar. Okay. And that way I can call you back in the order I receive your text. So once again, 505 322 7515. Okay, so Alpha, Marcus, Mike, Natalia, okay, Pat, Pedro, Big. Please feel free to just go ahead and send me a text, folks. That way I know who you are, and Susan as well. Okay, and that way we'll chat after the webinar here. So, folks, we help investors profit safely and develop consistency. It's at the core of our design and approach to the markets. So, meet our team. We have Jason, myself, Ryan. Okay, and we also have all of our investment consultants. Okay, and these are going to be the people that are helping you during your trial. Okay, so there's tons of help and support, guys. If you need anything, please feel free to reach out to us. Okay, and really, folks, on the left is going to be myself. My name's Dean. I'm a partner and investment consultant. Trial members, I'm your dedicated resource for any questions you have. Now, once you're a client, guys, you're going to get access to Jason. Okay, and you're going to have a chief investment officer to ask questions to. Each time you do have a questions about the markets. So, folks, what's our mission for you as an investor? Okay, pretty simple. Number one, engineer and build the safest growth for your hard-earned nest egg. Number two, educate you on how the central bank controls the market and attach your capital to it, as Jason was just explaining. Okay. Number three, answer any and all questions you have about our portfolios in the live interaction. Okay. So, who are the legends that we studied and why do we spend years doing it? Well, guys, to make long story short, there's 3 hedge funds on the planet that have ever been able to make money for 20 years. Okay, and we were and we very much looked at Ray Dalio. Okay, because he has returned the most money, so we looked deeply into what he does. Okay, we found out that he literally is always long or short 3 asset classes: bonds, stocks, and precious metals. That's it. Okay, we crunched the numbers and discovered that all 3 assets are controlled by the Fed. By allocating our portfolio's greatest concentration to bonds and stocks, okay, depending on what they're driving, then precious metals, we've invested ourselves with the same goals as the Fed. Okay. And next, we add a kicker to it by using leverage to outperform the market. Okay. And we're doing that specifically because we have quantitative easing in place. Then we add risk management components to bulletproof the setup. To top it off, we monitor the markets 18 hours a week, 18 hours a day, 5 days a week, so you don't have to. And we'll send you trade alerts directly to your cell phone via text message and via email if you need to make any adjustments to the portfolio. All right, guys. So many of our members make the cost of our membership either in their trial or after a few weeks, and that's going to take you less than 2 minutes to execute our portfolio structures at the set time of 11 Eastern. Okay. My challenge to you is to see how much you can make over the trial. And I want to ask you, is there a better way to build trust? Now, here's a screenshot of our top trial student, okay, with their profit. Okay, and to date, guys, this is still the best profit that we've seen, pretty substantial. making $97,000 in a week. And it's neat, team, because it's actually during the worst sell-off week that we've had in the past 20 years in the markets, right? So really neat. And this shows you the genius of risk parity and always having a backup plan. Okay. So we love to sleep like babies at night, knowing we're using risk management to protect our hard-earned nest eggs. Proper risk management provides consistency and reduces stress. I follow two really simple rules, folks, when it comes down to it. Rule number one, never lose money. Rule number two, don't forget rule number one. Incredibly powerful rules to follow. Okay. What's the number one? Now, I talk to people all the time, and I got to tell you, folks, 99% of the people I talk to every single day are absolutely clueless of the number one unknown risk to US investors today. Okay. And that's cash in your account. Okay. As Ray Dalio has famously said, one of the most successful investors of all time. I believe he's technically the second most successful investor of all time behind Warren Buffett, but he's actually been in the game a lot less time. So I think you're actually going to see him outperform Buffett over the long term. Okay. But he famously said, cash is trash, and it couldn't be more true. Now, did you know your cash is burning up sitting in your brokerage or bank account? Why? The Federal Reserve is printing money at the fastest pace in US history. You can leave your hard earned money in the fire, or you can learn to invest it safely today. Okay, and you can click on the link in the chat box, guys, to see exactly how to take your money out of the inflation fire, invest it safely. Okay, and after you do that, guys, click on the link to get signed up with us. That way you can get the education that we provide. Okay. And that way you can teach your kids and your grandkids what we're doing and how the Fed controls everything in the market. It's all controlled, guys. Everything in the bond market, the stock market, and the commodities, really the precious metals market is controlled by the Fed. Okay. So you got to understand that. So let's take a look at 4 examples to show you what inflation is doing to your hard earned capital right now. We'll use 3 simple variables for the examples today: cash, location, and time. Okay. Dallas, Texas, if you have 400,000 bucks sitting in your bank, okay, you're losing $30,000 a year to inflation because your annual inflation burn rate's about 7.5% there. Just got back from Dallas actually yesterday buying a car there. Okay. Next, let's look at example B, Miami, Florida. If you have $250,000 and you have 11% annual inflation rate, you're losing 27,500 bucks a year to the cash inflation fire. Okay. Example C, Bay Area, $250,000 in the bank. Okay. 13.5% annual inflation. You're losing 33,750 bucks. Okay. That literally works out to over 200 bucks a day you're losing each day that the market's open. It's crazy. Okay. Example D, if you're in Manhattan. Okay. If you have $1 million sitting in cash, you're losing $125,000 a year annually. Okay. So you can take a look at all these variables, right, and see how that all works out. Pretty crazy. And does Fed Chair Jerome Powell care about that? Nope. Is he pigeonholed to keep printing money? Absolutely. So think, folks, if you do this for 3 years, take all these numbers and multiply them times 3. It's shocking. Okay. So look at the rise and the fall of the dollar. So good question to ask yourself: how much capital do you have working for you? And how much capital do you have sitting in the bank being gobbled up by inflation? So let's take a look and see what the portfolio design is today after you complete the poll. All right, guys. So to complete the poll, if you haven't yet, simply scroll to this area in your screen. What's going to happen, folks, is you're going to see a gray bar that pops up, and then you're going to see an icon that says polls. It's 3 vertical bars as far as the visual image, and it says polls underneath it. Click on that, folks, and please reply to the 2 questions that are in there so you can understand how much cash that you have in the inflation fire today. Okay. And then I also want to know why you have that cash in the inflation fire. Okay. Because that's critical to understand. And look, a lot of people, I'm not kidding you, and I get someone every day that texts me and says, thanks, Dean. I really didn't understand how much, how risky having cash is right now. Okay. So that's the whole point of what we're doing, guys, with the poll. Okay. So make sure to fill that out if you haven't yet. Okay. It's really cool. To understand. So let's take a look what we're doing real quick. Okay. And guys, I actually have to hop off for a call here. But yeah, as Jason talked about, we're 60% long equities with some leverage because we do have stimulus and quantitative easing in the picture. But we have 32% of our long position hedged with volatility for downside stock risk protection. That's great. And you know what, guys? If Q1 2020 hits again, we make a massive profit. Okay. If you're just net long stocks like you probably are today, you won't, and you're going to get hammered again. Okay. And then, one individual company, we do this very, very rarely throughout our history, but this is one of those wonderful times that it makes sense to have a 6% allocation to the number one company that has a hedge to the coronavirus. Okay. Very nice. Okay, guys. So let's take a look at one of the best performing ETFs you can own today. So we own the S&P 500 with a free leverage ratio of 3 to 1 without paying for margin or loans. Okay, let's take a look under the hood of UPRO today to see why it outperforms the market in a huge way. Okay, so it has all the best companies on the planet inside of it by just owning a single ETF, right? Literally the best 505 companies on the planet are inside of it. What does the sector ownership look like? There we go. Okay. Top 10 index companies that you get exposure to. Some of the best companies on the planet. So how and when are you paid to own UPRO? And that sounds weird, right? But this ETF actually does pay you. And today is the last day you can actually own it to get paid a dividend on the 30th. Okay. So with the way the dividend and expense fees are working, your net return per 100 shares should work out to an annualized dividend of $1.32 per year. Not bad, right? So they actually pay you. Unlike the mutual fund that's going to charge you, UPRO pays you to own it. Okay. So in essence, UPRO literally, folks, is paying you to own it. Okay. So really cool. What does the performance look like of this asset? Well, it's done 33.18% since its inception. Massive outperformance of the S&P 500. And that's great, right? But we want to protect the asset with protective hedging for a safe ride. We do this work and watch the market 18 hours a day, 5 days a week, so you don't have to. Okay, so understanding our options, folks. So buy and hold is the best option for you if you have less than 100K. Okay, and it's had less drawdown compared to the Dow Jones in 2020, 80% less. To this point, it's had 39% outperformance to the Dow Jones in 2020. The portfolio simply uses ETFs to be long or short specific asset classes. Okay, and every once in a while we'll put in an individual stock like we have today. Minimal changes are needed throughout the year. We only made 5 changes in 2019. Okay, you're gonna get 15 hours, folks, of live education and Q&A every week. Okay, so even if you're not invested in the markets currently, but you've been looking to invest, guys, join us daily, get an amazing amount of education. Okay, and as you get comfortable, then put that money to work with us. Okay, so no options are used, but yet return 25.31% in 2019. Okay, no joke, folks. My 7-year-old is following the system. You can too. Now, the awesome free bonus, guys, you're going to get today when you sign up is a 30-day access to our $10,000 option trading bootcamp when you sign up today. You're also going to get that with the pro portfolio when you do your upgrade today. Okay, so let me take just a second here, folks. I'm going to go ahead and post that link into the chat box. That way you guys can get upgraded. Okay, and I got to hop off here any second to get on a call, but make sure to go ahead and click on the link in the chat box I'm posting in there now, guys, so you can get that bonus. Okay, and if you sign up for the pro, you'll be able to join Jason in his afternoon webinar, get his special trade that's going to be a put position, currently on one of the hottest running tech names of the year that's extremely overvalued, okay, that you can profit from. All right. And with that, folks, I'm going to go ahead and jump to this last slide here. Okay. So, folks, just give me a call, 505-322-7515 if you have any additional questions, or just simply send me a text, guys, and I will reply to you in the order I do receive those texts. So definitely look forward to working with you. Don, Frank, let's see here, Mike, Natalia, Pat, truly appreciate your time, folks. Look forward to working with you to show you how to grow your capital in the safest manner possible. Okay. Once again, simply click on the link in the chat box now to join. Okay. And if you have any questions before you do that, send me a text or give me a call, 505-322-7515. Thank you so much, folks. Have a wonderful day.